Hello Propenomix people, and welcome to the Sunday supplement from the 12th of November 2023. First of all, I know from my YouTube stats that 40% of people listening haven't subscribed to the channel yet, so I'd really appreciate if you're in that 40%, if you could just take the time to subscribe, like the video, and leave me a comment. Thanks a lot. So I like to start with a quote, and this week's quote is, "They shall not grow old, as we that are left grow old. Age shall not weary them, nor the years condemn. At the going down of the sun and in the morning, we will remember them." And that's from Lawrence Binyon, the English poet. So, this week I want to get stuck in with the macro update for the past couple of weeks, as last week I focused only on the interest rate and the truth, as I see it currently, about this market at the time. First though, the Bank of England minutes of last week's meeting in detail, in order to get some insight into that question that everyone wants answering. When will rates go down? We must remember, as I say so regularly, that base rates don't set the mortgage rate unless you're on a floating rate linked to base, of course. The mortgage rates, the fixed rates, are set based on the 5-year SONIA swap rates, which are derived from the 5-year UK gilt plus a premium, which varies depending on market sentiment and also on supply and demand. The price of the swap on the 5-year is the only one that was trading above its gilt price this week, which is upsetting as we'd much rather it trades under that price, then mortgages would be cheaper. Why? Well, there's a simple supply and demand argument. There's just much more demand for 5-year fixed rates than other fixed rates as a rule, because 2 years are still struggling with the stress tests that are being applied and are needing whacking great fees as a result. Borrowers who are refinancing are feeling stuck between a rock and a hard place. However, the swap rate is before the banks put their premium on to make a profit and cover costs. So because they are buying the 5-year in greater demand, and the SONIA rates are defined by the massive banks, not the challengers and packagers that a lot of investors tend to get their mortgages from, the volumes are truly huge. On swap rates other than the 5-year, the smaller lenders have to pay whacking great premia above the swap rate to get a swap done. And so that doesn't work unless there's a sudden massive demand for different products. Or, in plain English, they'll get you one way or another. Most people, the vast majority, don't see the logic in a long fix at the moment. It's more like the lesser of evils, which does make sense. Swallow it and stay in business, or sell up. A stark choice, really, and I've been very clear about where I am at on waiting for better rates, or for rates to drop. There were many thinking that rates would drop this year or go back to normal, and I've been vocal about my position on that. Only if something goes badly wrong. Base dropped to 0.5% in March 2009, remember, but credit was nearly impossible to come by at the time. I was laughed out of building societies and banks, self-employed at the time, and simply told not to bother. So price is not everything, although it is everything that most have concentrated on. On reflection, I really shouldn't have taken that to heart, but if I knew then what I know now, etc., etc. I also have to raise a mistake that I think the Bank of England is making at this time, and also declare a conflict of interest on this point. We all know the acronym QE, Quantitative Easing, but the acronym QT has not yet gained particular popularity, nor do I really expect it to. It stands for Quantitative Tightening. If you think of QE as the Bank of England, with the government's money on paper, buying government debt and achieving this by simply printing money, then avoiding the nuances, QT could be thought of as the government paying the bank back and money being set on fire. This isn't accurate because what actually happens is that in QE the bank buys debt and forces it out almost exclusively through the commercial banking system, with one side effect being inflated assets, of course. Because if debt is cheaper and money is nearly free, then returns on equity will rise and rise. The opposite is happening at the moment, but very slowly, because many large companies had the foresight to fix their debt for a long time when they're on their existing obligations when rates were very low. In QT, the bank instead sells that debt onto the open secondary market. Let me just explain that a little bit more. Regularly, most weeks, the DMO, the Debt Management Office, issues new government bonds. Roll up, they're never going to go bust after all. Much more interesting as well, at 4% plus, compared to the rates since 2009 and particularly since 2016. I couldn't resist a dive into the data, and since 2005 there have been 37 issues of Treasury bonds at 0.1% yield. This was between April 2020, no surprises I'm sure, and June 2021, when the sale flopped a bit and a 7-year bond with a 0.1% coupon, yes really, sold at around a 2.5% discount to par. In plain English, that means if you bought £1 million face value of those bonds, you'd have paid £973,600 for them and received a massive £1,250 per year for them, and received your £1 million back in June 2028. Mind-blowing, I know. A return of £35,150 over the term on a massive £973,600 invested and no inflation protection. Those buyers weren't reading the supplement at the time, you'd think. Last week, as a comparator, a 4.5% yielding bond sold at £100.102. So for £1,001,020, you could have had £1 million in bonds back in 2028 and £45,000 per annum. By no means the largest on offer in recent times, but still, we're 2 years and 5 months further on now, and the return over the 5-year term, rather than the 7 above, will be £1,020 loss on face value, but 45k times 5 over the term, so £223,980. An awfully big difference, 6.37 times larger, in 2 years fewer than the 2021 investment. So what? Well, the point is that the DMO sets the prices according to the market's appetite, of course. They have to be set in advance, not the night before. Institutions and other buyers need to know what they're buying and decide whether to enter the auction or not for the bonds. They will be considering price, duration, coupon, and their own obligations in the future, naturally. So in the past 12 months, there have been around 45 billion of active sales by the Bank of England into the secondary market. This compares to a little under 200 billion of issues by the DMO in the past 12 months. So, precisely 22.7% of all new issues that otherwise wouldn't have been sold. What's the alternative? That they're just left to mature naturally. Anyone with any sense will tell you that putting 22.7% more liquidity or alternative supply into a market will distort the price significantly. How significantly? The bank doesn't know, or if they do, they hide it very well on their website. And indeed, they don't really seem to care. The question was asked this week at a regional breakfast briefing for the bank, and they consider it a background affair, in line with their overarching policies to tighten. It does have a direct effect, because with that extra supply, of course, the price goes down, which means the yields go up. The difficulty is in saying by how much they go up, but they're higher than they otherwise would have been. The other consequence here, of course, is that they're also sold at a loss. Who takes that loss? I know you're going to know the answer to this, but the taxpayer, of course. If instead they were left to mature, and 35 billion have matured in the past 12 months, on top of the 45 billion in sales, the bank actually made a massive profit on these trades before. 124 billion in net transfers to the Treasury is the current position. Some because they had to buy long-dated bonds around the time of Liz the Lettuce to calm the markets down and stop pension funds having a complete meltdown and selling off bonds at a loss. These were bought at 5% yields and sold back off at 3.5% and 4%, which is a significantly profitable trade on a long-duration bond. This is one more reason why buying bonds of late for the right investors has been a good strategy. Yields are down quite a bit now, but still artificially high thanks to QT. One more fork in the eye here though. It's going so well that the bank is going to sell off 50 billion extra next year on top of the 50 billion that will mature naturally. If everything was left to mature naturally, as I strongly believe it should, then there would also be no losses to book. In fact, there would be profits because of the coupon interest. The Treasury really doesn't need these losses. The current forecast has been the 124 billion in net transfers provided will be wiped out altogether, because these need to be replaced by, wait for it, more debt, of course. Nuts, really, outside of the Bank of England circle. In the past 12 months, 30 billion has been lost following this strategy. This seems to be the first time I've pointed out, or indeed thought of, a downside to an independent central bank. Surely there's an upside here though, or at least a counter-argument. I can't think of it. If this was actively reducing the money supply, i.e. the bonds were actually retired rather than sold into the secondary market, then that would be a reasonable pushback. The money would then quite literally be being set on fire. Could the bank and the Treasury do this? Of course they could. It's by no means the biggest cooking of the books that's been dreamt up over the past few years. You can take a look at the April 2020 Financial Times, for example, which details just how the bank was allowed to bypass the bond market during the pandemic and simply transfer funds to the Treasury so that we could do whatever it takes during the pandemic. Not the worst idea at the time, and they only dipped into this for around 150 billion, although all records of this little exercise seem very difficult to find. Why would actively reducing the money supply in this way be helpful? Because at least it would be combating inflation, and that would justify some losses, if indeed they ended up being booked. Of course, without the cover of a crisis, remember, never waste a good crisis, this would be politically very difficult. Although if we lost 30 billion to temper 30 billion of higher payments on index-linked securities, that would not be bad business at all. The bank seems to have lost sight of the big picture here, though, and also seems keen to get rid of the asset purchase facility. The logic just escapes me, and if there are more seasoned economists reading or listening, I'd love you to tell me where I'm getting it wrong. It's hard to really understand the bank's position. The albeit technical question cooked up by me this week really got a relatively dismissive answer, although I don't blame the Bank of England rep. It's just too hard a question to answer in detail in an open forum. It would need a 10-minute explanation. My fear is that the committee simply haven't given it the relevant thought, and perhaps don't really care about the bond yields. It isn't their job after all. I hope it isn't just as simple as that. To put some meat behind what I'm saying here, let's look at correspondence from the bank to the Treasury from the 3rd of November. Regulars will know I'm cynical by default. From the Governor's letter to Jeremy Hunt, as set out in the minutes of the Monetary Policy Committee meeting ending on 20th of September 2023, the MPC has judged that quantitative tightening is going smoothly. There has been no evidence of a negative impact on market functioning across a range of financial market measures. APF reduction was likely to have had some tightening effect on yields, which, while difficult to measure precisely, was judged to have been modest. Allow me to translate. We're marking our own homework, and we think we've made a good decision and are not willing to challenge it. There's no proof that we've got it wrong, although it's difficult to tell, and we can't really measure it. APF is the asset purchase facility, i.e. the amount of bonds the Bank of England owns. It's not much, probably, so there you go. It's not great, is it? Jeremy Hunt's reply basically says, OK, well, this is your job and I'm not going to interfere, so get on with it. This is balderdash at the very highest level. OK, that's my rant over, and thanks for humouring it. Now the rest of the Bank of England meeting minutes, which I'll abbreviate in the interests of time after getting all that off my chest. The vote was 6-3 to hold the rate, as we know, with the 3 votes all being to raise the rate by 0.25%. That's a sign of how far away we still are from considering a cut. The bond market's expected, on November the 2nd, that rates would stay where they are until Q3 2024. So by then, we've had 5.25% for about a year, and then cut very slowly to 4.25% by August 2026. Let's pause here, though, because it is quite likely now that the time and the pace of the cutting will be underestimated. I wouldn't go crazy, but I think the lag effect will kick in and they'll be forced to cut before that. See the supplement from a couple of weeks back regarding the refinancing wall, apart from anything else. GDP is expected to be plus 0.1% in Q4, compared to the National Institute for Economics and Social Research forecast shared last month, expecting plus 0.2. So, recession avoided, but only on a technical basis. The bank expects 4.75% inflation in Q4 this year. At first glance, this looks very brave, given a 6.7% print in September. However, there are forecasts for October's print out in a couple of weeks to be 5%, because of the drop in the energy price cap, and from enough forecasters that I respect. It solely makes sense in reality because October 22's inflation print was 11.1%, thanks to the gas prices and a bit of lettuce as well, of course. My view is that realistic numbers are now finally being mentioned, but the next 12 months I'd be surprised if inflation averaged below 4%. Core inflation will remain above CPI. The bank predicts 2% inflation by the end of 2025 now. I'm expecting that prolonged stubbornness around the 3.5% to 4.5% level, as I've been saying all along. NISA sees rate cuts being possible in early 2024 if inflation is under 4.5%, which it expects it will be. I'd imagine the relatively hawkish committee will want to be sure before a cut, although some will no doubt want to point out the political pressure that will be behind a rate cut around the time of an election announcement. But remember, we have an independent central bank, of course. There's a rare mention of housing, which has obviously suffered the most from the rate rises as a sector, teeing up the autumn statement in a couple of weeks' time when the new as Daz is in the washing powder game, Help to Buy scheme is rolled out, no doubt. There are also whispers of a stamp duty incentive, but theoretically one is already in place for houses under 250k. Labour demand has softened, which is in line with what is happening. But in the big corporate world, hiring freezes have become job cuts, which is likely a sign of things to come in early 2024. The risks remain to the upside, and in this world it feels that will ever be thus, in terms of geopolitics and the impact on energy prices. And the last line in the report also caught my eye. Ben Bernanke, former Federal Reserve Chairman, engaged by the bank to review their appalling forecasting of recent years, I'm looking forward to that report, was in attendance. This week we've gone in reverse order, such as my desire to get all that off my chest, but I'll now revert to the macro scoreboards. Nationwide and Halifax have, first of all, upset all of the bears out there by printing 0.9 and 1.1% respectively in house price rises for October. This surprises almost no one who has followed my commentary about the real-time nature of their information. Rates were coming down in October, and some of those who were waiting on the sidelines have decided to wait no more. Each month concertina's demand, and with rising wages and houses looking cheap in real terms, regardless of what the rest of the media wants to say about them, the sludge of 2023 goes on with a fairly significant rise, which looks more like a September seasonal bounce than usual. Sales are being agreed, and whilst things are comparatively freezing compared to 2022, 2022 was white hot early on, as I've said many times before. Nationwide are actually very sanguine about it. Mortgage approvals remain 30% below 2019, which is congruent with the FCA data for 2023 so far, simply on pricing. Both indices have year-on-year pricing down 3.2 and 3.3% respectively, and Halifax thinks 2024 will be another fall. Both are on track with the narrative that rates are now stronger for longer, and as Zoopla have said, affordability won't improve until rates come back down in a meaningful way. My comment here would be that this could be a relatively steady decay, and it could be that they remain 1% or thereabouts below the base rate. Much more than 1% is unlikely, although the gilt yield has been nearly 1.25% below the base rate this week, and that's stretching the bottom end of the range really, certainly when you look at historical figures. Although this move from nearly nothing to 5.25 has also been unprecedented in that it started from such a low base. Nationwide's commentary reflects a slow progression back to buoyancy also. The forecasts were that October's print would be minus 0.4% for Nationwide and plus 0.2% for Halifax, so the forecasters were miles off really. The October PMI composite stayed below 50, although it beat forecasts. Services are very nearly holding their own, with manufacturing still shrinking according to the main players in the sector. The construction PMI for October printed 45.6, with 50 reflecting a stable sector, so shrinkage is still very much on the table, which surprised no one. The mortgage rate, the rate that banks are charging for variable mortgages, or the standard variable rate, unsurprisingly rose even further to 8.01% from 7.93%, as the big banks were slower to adjust downwards, in spite of a 0.5% cut in floating yields in the past couple of months. Price gouging accusations are already out there, and expect more negative press for the banks in recent months. The RICS house price balance was also better than expected, but still a very bearish minus 63%. The best reading for 3 months, but still the lowest print since 2009. The market continues like a mini 2009 without the credit issues, where transactions continue to stay low, and stock on the market still looks relatively low, as people know now is not a great time to sell. So only the motivated and those who have their fingers in their ears are on the market. Quality still sells quickly from what I'm seeing and hearing, and I mean quality within that price band. Friday this week was full of data, with the major headline being the GDP growth rate. The expectation was a contraction of 0.1% for the last quarter, but in reality it was a big fat zero. So it exceeded those low expectations and in reality simply kept up with inflation. Not terrible, simply symptomatic of the sludge we're still working through. The only people to have been upset by this will be the journalists, as it means no recession headlines for at least another 6 months, not even the ones hinting at a recession. The quarter's growth annualised is 0.6%, with 0.2% of that having come about last month. Year on year, the growth is 1.3%, although this flatters because September 2022 was subdued due to the passing of HM Queen Elizabeth. 0.6 is nothing to write home about, but the economy lumbers on like a wounded beast, coping with the inflation forced by the gigantic pandemic stimulus. If we went back in time 12 months, I think we'd find exactly where we are today as an acceptable outcome. Electricity is down 85% on the ridiculous spot price highs of 2022's autumn, and Putin ultimately was foiled from a selfish UK perspective. I remain concerned that he can manipulate the oil price, but in mid-November you would think he would have fired that bullet by now. Once again, we're the beneficiaries of a milder than normal winter according to recent forecasting. We'll never know how lucky we were. Business investment had a bad quarter but is still up year on year. Investment was curtailed after the super deduction in expiry in April, of course, so to be up 2.8% year on year is helpful. Infrastructure investment has helped. Construction orders had their 4th negative quarter in a row to slip back to 20% lower than 12 months ago, and no wonder some are feeling the pinch on that front. Hard to see a major resurgence, but reserving judgment until the autumn statement would be a sensible move. Friday's figures mostly exceeded expectations when it came to growth, and push yields up again because the economy simply isn't looking as trim as it was. I wanted to close the macro roundup with one fairly significant point though. The money supply is flat or contracting, as it needs to on the back of the stimulus. The velocity of money has continued to pick up, but prices have also responded significantly. Almost all of the indicators that showed inflation as highly likely in early 2021 are now showing inflation as much less likely. So the overarching news is that the pace is out of the entire piece. Wage rises are sucked up in getting back to where living standards were, largely, and so not as inflationary as they've been in the past. And next year's wage rises are simply not going to be as large as this year either. The problem really is that people have taken the brunt of their part, now it's over to the corporates, to simply accept lower margins in order to stop services inflation continuing to rage away. In reality, this is only likely to stop when corporates don't think they can get away with further price rises. Cuts are already in place in terms of headcount, and individual firms will have to increase productivity by having fewer heads who are better paid. And that's the route the largest have already started going down, it seems. That way they can just about maintain margins in what is now going to look like a relatively disinflationary, not deflationary, just lower inflation environment. I'm sure to build on this point in coming weeks and months. Next week we're treated to unemployment and inflation data. There'll be lots to say, I'm sure, and I'll be here saying it. Until then, just to reiterate, if you haven't subscribed to the channel yet, I'd really appreciate it if you do on the podcast platforms or on YouTube, depending on where you're listening. Please leave likes, comments, and share the supplement as well. That will help me get more subscribers, lead to more and better content, and that's the aim for everybody. So there's only one more sentence. Drum roll, keep calm and carry on.